Hello, and welcome to Wealth Management Insights. I'm Monica Guerra, Head of U.S. Policy for Morgan Stanley Wealth Management, and I'm recording this audiocast on Monday, November 17th. Today, we'll be discussing the recent resolution of the U.S. government shutdown and its implications for the market and economy. President Trump signed a continuing resolution to reopen the government on November 12th, ending the record-setting 43-day shutdown. The longest shutdown in U.S. history was driven by several factors, including differences over healthcare policy and federal employment measures. Reopening the government came after a bipartisan coalition of senators voted to pass the measure. It was then passed in the House of Representatives, largely along party lines, and then signed into law by the president. This resolution extends existing funding levels through January 30th, 2026, and includes full-year appropriations for the Departments of Veteran Affairs and Agriculture. Retroactive payments to furloughed federal employees are also included, a measure that prevents layoffs in the renewed funding period. Now let's look at the market and economic implications. Historically, shutdowns have limited economic impacts. Since 1976, quarterly GDP has increased by 2.2% during shutdowns on average. And the Congressional Budget Office estimates that the U.S. economy will permanently lose between $7 billion and $11 billion in GDP due to this shutdown. However, this indicates limited spillover to an economy valued at over $30 trillion. Equity markets have also been resilient and rallied approximately 2.1% over the current shutdown period, which is consistent with the average gain of about 2.9% historically. In fact, the market has been positive over the past 6 government shutdowns. This suggests that macroeconomic, thematic, and cyclical factors play a greater role in market performance than legislative deadlocks. Looking ahead, our attention shifts to the potential vote on the Affordable Care Act subsidy enhancements. The expiration of these subsidies could lead to higher insurance premiums and reduced enrollment. Failure to extend the subsidies could result in another government shutdown next year. This adds pressure for a legislative solution. However, uncertainty could cause interim market volatility, particularly in sectors directly affected by healthcare policies. In addition, the shutdown has driven expectations for delayed economic data releases. As a result, the Federal Reserve may have an incomplete picture of the economy during its upcoming meeting in December. We encourage market participants to remain vigilant as new data becomes available. In conclusion, while the shutdown has ended and economic and market impacts have been limited, uncertainty remains around key legislative issues, particularly the ACA subsidies. Investors should remain vigilant and consider the broader macroeconomic factors at play. As always, thank you for listening. For more detailed insights on policy, markets, and the economy, please reach out to your Morgan Stanley financial advisor for our latest U.S. Policy Pulse reports.